Uh, let's do it right. Let's say welcome on, and thanks for being here. And as you all know, the Beginner's Corner's idea is to help traders at the beginning and also along their trading experience, right? By providing the point of view of different Forex experts. With that in mind, there's just one thing I would like to say before starting. Over all these years I have been in trading, I have been asked several times which is the best indicator, which is the best system to trade, and always my answer has been the same. It's not the tool you use, but how you use it, right? Indicators are just that, tools for our work. However, it's a pleasure and an honor to have today here Greg Michalowski and the Trees Crowd Strategy, as I believe that it's as simple and as good a trading strategy can be. I have tested, and I do honestly believe it's among the best ones. So great to have you here, Greg. Really thanks for sharing your knowledge with us. Welcome, and I hope everyone enjoyed this webinar, okay? Pay attention to Greg's tips, okay, everyone? Enjoy.
All right. Thank you very much, Val, and thank you very much for all the people at FX Street here for allowing me to come to you wherever you are in the world to give you my thoughts on my trade strategy, which I call the threes a crowd. Before we get started, however, let me remind everybody that trading foreign exchange is risky. You stand to or have the potential to lose some or all of your risk capital. So be sure that you do things like define your risk, limit your risk, so that you don't blow up your account. Also, during this webinar here today, I don't intend to give any buy, sell, or hold recommendations. It's purely for educational purposes only. Please keep that in mind as we go through our webinar here. You can read the disclaimer here that we have here at FXDD. Now, I am a employee. I've been working with FXDD now for the last 11 years, and ever since day one of FXDD. And so I've been able to see what a lot of traders do right and what a lot of traders do wrong. And I know that this course is a beginner's course. So we're going to take it a little bit slow. We're going to go through this trade strategy in a methodical way, but we're going to make sure that we do cover all our bases here, and I show you lots of little examples of how you can use the threes crowd strategy. Now, one of the things that I do at FXDD is I am a contributor to the Forex Live. That's www.forexlive.com. This is one of my posts from earlier this morning, and some of the things that we will learn here today, I definitely use in my analysis on Forex Live. So you will be, if you go to that site and you see my commentary there, written commentary there, you should be familiar with it especially after we go through this webinar here today. We're also, just a little plug, for those people in the Florida area, we'll be doing what is called a Masters Live full-day seminar. That's me right there, so you get an idea of what I look like. But that's me teaching at a prior Masters Live. Myself and James Chen will be in Miami at the Doral Golf and Country Club. If you have interest in attending, just go to www.fxddmasterslive.com. Okay, enough for the commercials. Let's get this webinar going here. And this threes a crowd strategy really has its derivation from that old saying, two's company, three's a crowd. So I thought I'd show you some pictures of examples of two's company, three's a crowd. Here's some cute little monkey sitting on a swing set, and the third one, he doesn't fit. So two's company, three's a crowd. He cannot be participating in that. We have, I don't know what these are. These are some sort of, are they puffins? I don't know. There's some sort of fat, short birds, I guess. That don't look like they can fly very well, but they look like they probably waddle well. And here's two of them over there on the side, and the third, and notice how that second one's kind of looking at the third one saying, get away from me. This is my girl. You stay away or else I'm going to peck at you. This third example, I think swans. I think swans mate for life. I could be wrong in that. But here the two lovebirds are there touching beaks there, and and the third one is just moving away from the two lovebirds. That's two's company, three's a crowd. And it wouldn't be right to not include a human element in the old saying, two's company, three's a crowd. Brad and Angelina and poor Jennifer Aniston. She got nixed out of that relationship that she was married to, I guess, Brad Pitt. That no longer was the case, and so it became three's a crowd for that situation, at least for Brad Pitt, and poor Jennifer Aniston moved over to the side. I know when I was dating with my wife, and initially she was a little bit unsure about me, so her friends used to hang around, and then we got a little bit more serious and became a little bit more. Well, honey, three's a crowd. Can you tell your friend to kind of move off? So it kind of happens in all phases of life, whether you're an animal or whether you're human. This idea of two's company, three's a crowd exists in human nature in the world that we live in. And when you have this three's a crowd situation, one of them has to go, has to move away. If it's Jennifer Aniston, you got to move away. If it's a Puffin, you got to move away. If you're a Swan, get away from us. We're the couple. You go away. And the same goes true in trading. I realize that in certain situations, from a technical standpoint, there are these opportunities or these instances where you have two's company, three's a crowd. That is, the price starts to move away, or something has to move away, something has to give way, and it gives you an idea as a trader. It gives you some clues as a trader of potential market movement. And what will move in my three's a crowd situation is what I will do is take a look at two moving averages, and then I'll look at the price. So I have two moving averages and the price, and they all converge at a single level. And when those two moving averages and the price converge, forming this three's a crowd situation, we're not going to see the picture yet. I'm just going to explain it to you. But when it forms this three's a crowd situation, what typically happens is one of the things has to move away. And what do we know, or what do some people know about moving averages? Maybe you don't know, but what we know about moving averages typically, or what typically traders learn about moving averages, is that a moving average is a lagging indicator. It lags the price movement. The price moves, the moving average moves after it. And so when you have two moving averages coming together along with the price, that creates a situation where three's a crowd, and guess what has to move away? The price. That's important. That's an important clue for traders, because if you are anticipating that a price is going to move away when the three's a crowd situation occurs, that is going to be an important clue for your trading. You simply have to then look for a break to confirm the directional bias for a trend-like move. Once again, if the moving averages and the price are converged, one of them has to move away. Which one is it? The price. If you know the price is going to move away either to the upside or to the downside, that's an important clue for you to start to anticipate a trending move away, a trend-like move away. And that's the importance of this three's a crowd strategy, is you as a trader now have a window, almost a crystal ball that says it's time to think about the price moving away. All I have to do is figure out which way the price is going to move. So before we get into any more details as far as this strategy, looking at charts, trying to show you what exactly I mean, I want to make sure, since this is a beginning course, I want to make sure that you all understand what a simple moving average is. And I have a simple example here where I'm going to take a look at a 3-bar simple moving average and just show it to you in algebraic or mathematical terms here. A simple moving average takes the closing price of a series of bars, adds up the values, and divides that number by the number of bars in the series. So in in terms of a math equation, if you want to figure out a 3-bar simple moving average, you take the close of one bar, you take the close of the second bar, or you take the close of the last bar. Let's call that close 1. Then you take the close of the bar just previous to the last bar. That's the close of 2. And then you take the close of the bar that's 3. That's the third bar away from the current bar, and that's the close of the last 3. And then you divide by 3. So if the close of this current bar is 131.60, and the close of the prior bar is 131.50, and the close of the bar just prior to that bar is 131.40, you add up those 3 bars, 60, 50, and 40, and divide by 3, and you get an average price just by looking at it at 131.50. So that is how you calculate a 3-bar simple moving average. Now, if you had another moving average, and let's say it's a 6-bar moving average, you do the same thing. In this case, you take the close of the last 6 bars in your chart, add up those closing values, and divide by not 3 but 6 this time, because there are 6 samples, or six I don't know what do they call it, math, six well, let's just call it units in this calculating the moving average. So you take the closing bars, if you have these prices as the closing bars, you add them all up, 1, 2, 3, 4, 5, 6 of those, divide by 6, get the 6-bar moving average of 131.50. So in our example, if the current price is now trading at 131.50, and the 3-bar moving average is also at 131.50, and the 6-bar moving average is also at 131.50, that is the situation of a three's a crowd. 2 moving averages and the price converging at the same level creates the three's a crowd scenario. And at that point, I start to anticipate one of the 3 to move away. And what we know that moves away is going to be the price. It's not going to be the moving average first. It's not going to be the 3-bar moving average. It's not going to be the 6-bar. It's going to be the price. The price is going to move away first. That's the beauty of this three's a crowd, is now you can start to anticipate the price moving away. Now, my simple example of defining what a moving average is and how it's calculated, this is the beginner's course, is just I wouldn't suggest that you try to do the three's a crowd with a 3-day moving average, a 3-bar moving average, a 6-bar moving average. They're just too quick. Now, what I love and what I've found works very well is the 100 and 200 bar moving average. So here we're taking a look at 2 longer-term-ish type moving averages. The 100 bars, so we're taking the average of the closing price of the last 100 bars, and then taking 200 bars and averaging those up. And imagine that you're taking those longer-term moving averages of 100 and 200 bars. I don't care if it's a 5-minute chart, I don't care if it's an hourly chart or a daily chart. That's a long time. That's a long period of time. If I like to use a 5-minute, I like to use the hourly. I like to use a daily chart. But even if you're taking a 5-minute bar and you take 500 or 100 bars, that's 500 minutes. That's a pretty long time. It's less than 10 hours, more than 8, somewhere in between 8 and 10 hours of trading where the moving average is calculated. So it's a long period of time, and then you double that and say, well, we're going to have 16 hours or so, 16, 17, 18 hours of closing bars, and these 2 moving averages converge. So it doesn't happen that often, but when it does happen, it tells you something. It tells you something about what the market is doing. And the reason why I like to use the 100 and 200 as my moving average clues is that I tend to find that the market follows these two moving averages. As a result, what typically happens is that there's an energy that develops around these moving average levels. And that also comes into play in this three's a crowds trade, because not only do you have one moving average there, but you have 2, so there should be increased energy at these 2 moving averages when they're converged at the same level. But let's typically when a normal chart occurs, that is when it's not in a three's a crowd situation. I consider the three's a crowd situation, more of an abnormal, if you will, than normal. But that still happens a number of times. But typically when the price moves above or below the 100 bar moving average, in my charts. I consider that a trigger, and that's a trigger to buy. If the price moves below the moving average, that's a trigger to sell. Imagine a moving average line. Price moves, or the price moves above it, that says the bias is turning from bearish to bullish. When the price moves from above to below, that says the bias turns from bullish to bearish. And we'll look at a chart, so don't worry. We'll get to what that actually looks like. And a target, once you pass the 100-bar moving average, or the trigger in my terminology, you then start to look for the 200-bar moving average as a target down the road. And the 200-bar moving average is what I can call the confirming moving average. It confirms the trend. So if we take a look at a chart finally and get to look at what this looks like, the blue line is our 100-bar moving average. The green bar is our 200-bar moving average. And so when the price moves below the 100-bar moving average, that triggers something. It triggers a sell. And so because we went from bullish above to bearish below. And so when the market moves below this line, we need to get below this confirming moving average. And you can see it tries to get below, but there's no momentum on that move, and the price moves back above the 100-bar moving average and moves above. And then we go a little bit below and we fail again. And then we go a little bit below, or go below and we come down to the 200, and it can't get through it yet. And notice here what our moving averages are starting to do. They're wider over here, wider over here, getting more narrow over here, narrow, narrow, narrow. And oops, didn't mean to do that. Eventually, what you're going to get in this type of situation, folks, is that this converging of these moving averages, this non-trending consolidation eventually leads to a trend. And eventually the market finds its way, starts to break below the 100 and the 200, and then we start this trend to the downside. In today's trading, or the last few days of trading, we moved above the 100-bar moving average. Could we get to the 200-bar moving average? No. Look how far away it is. It's a long way away. This is a normal situation after a trending market. The 100-bar moves quicker than the 200-bar moving average. And so there's this time where the market has to catch up. The moving averages have to catch up with each other. And you can see that they are, because the 100 is starting to move up and 200 is starting to come down. But today we didn't have the threes crowd situation, or as close to this threes crowd situation that we did here. We had the two moving averages moving or a far way apart, and you can see that we traded in between these things. Eventually the market moved to the upside. So this is more of a normal situation. Even this is not necessarily what I consider the threes crowd. I want to see those moving averages get even closer than what they are in this chart, because even at this point right here, if we kind of calculate where the moving averages are, this 100 bars around, I don't know, 132, 90, 95 in this, or the 200s there, and the 100 bars at around the 20 level. So there's about 20 pips apart, 30 pips apart in between those two moving averages. Not quite threes a crowd situation. It did end up trending to the downside, but it wasn't what I call my threes a crowd situation. But I just want to get you familiar with those two moving averages. So when the price is trending or finishing a trend type move, the 100 and 200 bar moving average will be a distance apart. And the market tends to have a more difficult time breaking through the 200 bar moving average at that time. So if we go through our example here, we just trended to the downside. So we have this distance apart between our two moving averages, and it makes it a little bit more difficult to break through that 200 bar moving average. It's just not ready. The market's not ready to change direction of this, what was a trend to the upside here, turning into a trend to the downside, and changing direction from a trend to the downside to a trend to the upside. So you get this trading in between what I call the goalposts, in between the 100 and 200 bar moving average. Now, conversely, when the 100 and 200 bar moving average are converged, if these two moving averages are converged, and the price is at the same area, what does that say to you? And to me, that says to me that the market is non-trending. Again, 100 bars going back, closing price, average price equals X. Take 200 bars back, take the average price of those 200 bars, and it equals Y. But X is equal to Y in this case. that suggests to me that this market is in a non-trending environment, that the average over not only 100 but 200 bars is the same and the price is at that same level. That's a market that's in balance. That's a market that's non-trending. And what do we know about non-trending markets? And this is important, especially for your beginning traders. You must understand that non-trending markets will eventually transition into a trending market. Non-trending markets transition into trending markets. Trending markets transition into non-trending markets. So if you have a non-trending market like we have right here in this simplified chart right here, if you have a non-trending market, you can start to anticipate that the market has a potential to trend. If you can anticipate the market has a potential to trend, you have a better chance of catching that trend. Let's go back here and anticipating a trend move to the downside. And one way that you can figure out that the market is non-trending is by looking at 100 and 200 bar moving average. If they converge and they converge at the price, the market is non-trending. The market has a potential to trend at that point. You start to anticipate a trend, start to look for the market to move away, to get away, to have that third wheel in the crowd or in your group to move away, to get away because you want to date Angelina Jolie. All right, so let's take a look at a chart and take a look at a true threes a crowd situation, a situation where our 100 and 200 bar moving average converge. So we have the green line converging with the blue line, and this is threes a crowd. So when I start to see this occur, I say to myself, okay, time to wear my best suit to work, time to think about a potential trend. Now the question becomes, where are we going? Are we going to go up? Are we going to go down? And what are the targets for our trend type move? So whenever you have this situation occur, you're going to have some certain characteristics. Moving averages converge, moving averages are moving sideways, and the price equals moving average. That's the characteristics of the threes crowd typically. We're seeing the 100 bar moving average move sideways, seeing the 200 bar moving average flatten out and moving more sideways here along with the price. You tend also to have more of a non-trending type ranges. If you take this low right here, this is at 130.55. This high is at 130.85. So we're talking about 30 pips. You go to this low right here, and it's 52. So now we're talking about 34 pips. 34 pips in a range that extends over a certain amount of time, which goes from let's say about 5 o'clock to 14. This is about 9 hours of trading. Now, what I know when I'm trading is when the market's in a very narrow trading range like it is here, I know that the potential exists that this market isn't going to stay in this narrow trading range. We're not just going to stay in a 35 pip trading range or a 40 pip trading range for an entire day for, 12, 15 hours, 24 hours, or whatever. The market's going to extend one way or the other. So I'm getting all sorts of clues here that the market has a potential to move. Now, I don't know which way it's going to move, but what I know is that if the market breaks through this trend line and that if the market should move lower here, and it's below, the price is below the 100 and 200 bar moving average. So it's giving a bearish bias here. I know that if we can move below this line, if we can move below this low, if we can move below this low, then it really opens the door for a move through our low for this period at 130.32. So this market would trend to the downside, but we need to know where we're going. So if we're going to go down, we need to get through this level, we need to get through this level, and that helps confirm the trend in the direction you're going. On the upside, what do I know? If the market moves to the upside above this 100 and 200 bar moving average, we need to get above this trend line. We need to get above this high, and that opens up the door for the move to the upside here. So those become our targets, and those are important in the threes of crowd trade because sometimes the market won't necessarily go trend right away in the direction that you think it might go. It might give you a fake out move and totally reverse and go the other way. But when the three's a crowd situation exists, you as a trader have to realize that it's going to exist. If it fails, it's going to still exist. So you still have to look for a move, and it might be in the opposite direction that you think. So let's see what happens here in the trade. So here we have the market. We were at this point right here in the last picture, and I said that the market was more bearish because it was below that line. And what did we do? We went below our levels here. We went below our trend line. We went below our low here. We went below our low here. And so we're on our way to new lows. But what happens here? If you were to sold the market at this point or in this area right here, anticipating the market's going to trend to the downside because of the three's a crowd, you did get satisfaction. Broke here, broke here, broke here, but we failed here. The market quickly fell below this line. It should have been heading down here, and it didn't. It started to move back to the upside. So if you're short in this area right here, folks, and the market starts to take back its gains that it had, breaking below of its targets, it's going back above targets that it just crossed, it's saying something to you. So in my situation here, I would look at this as a failure. I may stay in until the price moves back into this triangle right here, but if I'm short in this area right here and the market does this and it starts to retrace back above this areas right here, I'm getting out here and I'm starting to reevaluate this three's a crowd. Which way are we going to go? Is this failure an indication that the market has wants to go to the upside? And I give you this example why? Because you have to be aware that these situations don't always pan out as you expect immediately, as in the direction that it should go. And so you always have to be on your toes and have these target areas in line. And if it starts to retrace some of the moves that it initially moved, it retraces some of the moves and goes back through some of the key levels that it broke to the downside in our example here. You got to recognize that it's time to get out. It's time to reevaluate, but still look for the trend. And so when we leave this chart right here, we're right back at our 100 and 200 bar moving average. Three's a crowd is still in effect here. We're still anticipating a trend move away. So we're back above these levels here, and then what happens? The market starts to move above and starts to find support against our 100 and 200, and we start to break to the upside, break above here. So just like you would sell through here, what you have to do is buy through here. It still exists. Still look for it. Look for the move look for a move away. Three's a crowd exists. And if you were to take the clue and sold in this area, gotten out when the market moved back above here, and then continue to watch our support areas in here and taken the clue to the upside, yes, the market did trend. The market breaks away and it trends away to the upside, moving from about the 130 69 level all the way up to the 130, 133 level, corrects down to our 100 bar moving average and moves further up to the 130, 143. So this is an example of the three's a crowd situation, which wasn't all that clean, but it trended away, and that's what you have to look for in a trend move away. Now let's take a look at something else like the euro versus yen. This is the same type of situation. This is an hourly chart instead of a 5-minute chart that we're looking at. And in this case, we have our two moving averages start to converge again. And in this case, it's a little bit cleaner than that than the 5-minute. We do have a few little bars here. The market moves up and down, up and down. You have to stay with it, folks. But you have to stay with the understanding that this market is poised to move away. It's poised to move one way or the other. And if you trade around the 100 bar and 200 bar moving average, you're going to get an opportunity where the market's going to break. And finally, what we see in this example is that we have a nice little trend line here. We have some nice little ceiling level here against the lows and highs, and we have some floors here. So we have a ceiling developed here, and our 100 and 200 bar moving average are in between. We have a target on the top side which we have to get through, the top side moving average. We have a target on the bottom side that we have to get through. This is this trend line right here, this trend line up here. We have our two moving averages. And note here this bar right here. This bar is a clear break. We use the 100 and 200 bar moving average as our resistance level. We broke through the trend line. You as a trader have to think in terms of selling in this area. If you sell in this area, risking a move above that line to get you out on a break. But you have to anticipate that the market has a potential to trend, and when the market breaks through this level, you have to anticipate that it's going to remain below that level, remain below the 100 bar moving average. And if you did, and if you're aware of that, if you're prepared, if you're anticipating a trend, you have the market to trend to the downside, breaking through it around the 109.92 level, and moving down through. Here it breaks through at the 109, a little bit higher than that, probably around the 110 level on the top side at this point right here. This started around the 110.14 level. So you as a trader, even if you sold at this 110 level, your risk is a move to the 22 level above this old high right here. That's your risk. 22 pips in the euro yen is not all that much of a risk. And then your gain. You don't know what your gain is going to be, but what you do know is that if you're anticipating a trend, what are trends? Trends are fast, directional, so you tend to look for that momentum in the direction of the trend break. And in this case, 2 hours later, you're risking this amount of the trade. A couple hours later, you have a few multiple of that risk on your position. If you were able to gut it out for even a few more hours after that, 4 or 5 hours, you have a move from about 110 to 108.75, risking 22 pips on the trade initially. Not much of a risk. Potential for more on the gain. That's because you're anticipating a trend. You're anticipating a move away from these two moving averages that are converged. Let's take another look at the dollar Canada. This will be our last example, and then I'll go to the questions and answers. But here we have the dollar versus Canada, and this just occurred a few days ago as well. Had this narrowly chart just like the euro yen. We have our two moving averages converging here at the same level, somewhere around the 99.50 or so level. And so you as a trader now start to anticipate something happening. Imagine that you don't see that all this happening to the upside, that you're looking just at this area right here. See our two moving averages converge at that level. You as a trader start to anticipate a move away, break away, somewhere this market is going to go somewhere, either the upside or the downside. On the downside, if you're looking for a break to the downside, and it does break a little bit to the downside here on this bar right here, you need to get to this area right here, this old low. If it can't get to that low, guess what? You're not trending that direction. And so it becomes the 100 and 200 bar moving average become a trigger. These other levels right here, like this low right here, becomes your target. If you can't get through that level before the market starts to break higher, guess what? You may think about going the other way. So the market starts to break a little bit below here. We find in the next bar that we cannot move any lower than what the previous low really. In fact, looks like it has a double bottom right here. And right at this point, really when the two moving averages converge right there with the price move above that level, and this bar is a little bit more stronger to the upside. Rejection of the low, acceptance of the higher level. And then we start to find support against our 100 bar moving average. What's your risk on this trade? A move back below those 100 and 200 bar moving averages. Could it happen? Yes, it could happen. In fact, if it were to happen, I would start to think in terms of the market moving back further to the downside, the possibility of it. I'd be looking for momentum in that direction. Do we get a break to the downside? No, the market never finds that break to the downside. You who are getting long in this area have the potential still that the market can go to the upside. Do we know it? No. Do we know our risk? Yes. Is our risk defined? Yes. Is our risk limited? Yes. Do we have the potential for larger gains? Yeah. Do we know what those larger gains might be? No, but what we're anticipating is that when these two moving averages converge, there's going to be an energy developed, and that energy is going to push the market in a direction away from those moving averages. And so time goes by and the market finds its way and then surges to the upside. In this case, we move from about the 99.50 level all the way up to the par 50 level, and a nice little 100-point move and a nice little trend directional bias to the upside here. Now, I want to take this just a little step further because here we have our 100 and 200 bar moving average converging somewhere around the 99.50 level. Now, I want to I've showed in the past both the 5-minute chart and the hourly chart. This works on all charts. I look at it on a daily chart. It happens less and less as you go further out on different chart periods. But when it does happen, you still be aware of it. Look for a trend move away. But let's go back and take a look at a 5-minute chart and look at the same situation here, somewhere around the 99.50 level where we broke on the hourly chart. And if you take a look at the 5-minute chart at that point, we have our two moving averages, and they're starting to converge down here as well. Now, it does look like they're a distance apart here, but if you were to really look at the level of the 200-bar moving average and the 100-bar moving average in this case, this is at 60, this is at 64. So we're only 4 pips away from each other with on the 5-minute chart. So this chart is also telling you the same thing that the hourly chart is telling you. In the shorter term, the market's non-trending. In the intermediate term, the market's non-trending. The two moving averages are converged with the price. Threes a crowd exists. Do you have more confidence that this market has a potential to move away? I do. You should too. Look for this situation. In this case, you can see here that it was giving you nice little clues here along the bottom. Low, 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 100 bar, 200 bar. Resistance, resistance, finding support, moving above, coming down to the 100, breaking above, using that, and propelling yourself to the upside here. Note here the correction even comes down right to the 100-bar moving average, and we get that next leg to the upside. So, folks, the point is this: is that you can find these two moving averages, these threes of crowd situations in your chart. Start to look for them. Start to look for the situation where 100 and 200 bar moving average converge, and then start to anticipate something that may happen. Anticipate a trend type move away from the current level. Have that price move away from these moving averages. And that, my friends, is where you, as a trader, start to reap the benefits of trends in your trading. And trends are where you have the potential to make the most amount of money because they move away very quickly. They're fast and they're directional in nature. And I want you to reap these gains, to be able to ride the dollar versus Canada to the upside when you don't expect it to happen. I also want you to start thinking in terms of non-trending transitions into trending and how you can start to anticipate trends by looking at simple trading tools like the moving averages, having them converge. Look for that threes of crowd. You'll find that it helps you out, that you'll be able to catch more trends, and with those trends, increase your account balance. So that does it here for my presentation here today. If you have any questions, or back to you, Val, if you want to moderate any questions and answers, I'll be happy to answer them for you out there. I appreciate your time, appreciate your support. Val, back to you. All right. So if anyone has any questions or wants to take a look at any other markets, I'd be happy to do that for you. Otherwise, this will end our presentation here. So very happy to help you. Euro. Why simple? Okay, here comes a question. Why simple moving average and not exponential moving average? I use a simple moving average because I found that it is followed more by the market. In the foreign exchange market, what is the foreign exchange market? It is a collection of traders coming together, a large number of traders coming together, looking at the same transparent pricing, same charts. So I can be looking at a chart here in New York. Someone else can be looking at the same chart in London. Someone else can be looking at the same chart in Australia or Tokyo or wherever around the world. We're all looking at the same chart. And I find that the simple moving average is just a moving average that most people tend to follow. I also believe that I believe in the KISS principle, keep it simple to be successful, is the way I look at the KISS principle. And the KISS principle has that word simple in it, and so does a simple moving average. I for one, can explain in a webinar, in a seminar, how to calculate the simple moving average to beginner traders as an example. An exponential moving average, I know it's quicker. I know, it looks at more recent data, but I'm not really necessarily looking to have to be able to catch a trend earlier. In fact, sometimes the exponential moving average can catch a trend or what seems like a turn in a trend earlier than the simple moving average, but it doesn't necessarily mean that it's going to follow through. In fact, it may be that it goes to the exponential moving average first and then finds support against the 100 simple moving average because more people follow the simple moving average. So the long and short is simply I think that the simple moving average is followed by more traders out there, so I use a simple moving average. Now, the other thing about moving averages, I said that they are lagging indicators, or that's the way they're branded in the market as a lagging indicator. I'm not necessarily looking to buy or sell highs and buy lows. It's nice to think that, and there are tools that you can use to try and anticipate that. In fact, I use trend lines or channel trend lines. Imagine that we're in an upward sloping channel and the market goes up and tests in a trend to the upside, and the market goes and tests that top trend line. I am anticipating a high being in place. I'm also able to define my risk against that trend line. So if the price goes above that trend line, I can simply get out of my trade. So imagine I'm long following the trend because I got on a 3 ground trade and the market goes up to a top trend line. I can get out at that point. Now, so I don't just use moving averages in a vacuum. I use them in conjunction with other tools like a trend line and Fibonacci retracements. In fact, those are the only tools that I do use. Trend lines, Fibonacci retracements, moving averages. This example here, using the moving average, is a way for you to anticipate a trend, is one of the ways that I do it. But getting back to the moving averages, the idea that it's a lagging indicator, yes, it's lagging. Why? Because the price moves first. But what I use the moving averages for is a trigger, a place where the bias turns from what was bullish with the price above to what is bearish with the price below. And so I'm looking for just movement away from those moving averages, and I find that the simple moving average just really works better. Doesn't necessarily mean that I've done a study on it. I just feel very comfortable with it, and I like to use it in that respect. So that's what I do. The third of the three is a crowd is the price, the two moving averages and the price. That's the third thing. So you have two moving averages, 100 and 200 bar moving averages, and the price. So that's the three things. Two moving averages and the price. Two moving averages are the pair. They stay together. The price starts to move away. Okay. The questions in regard to some of the other currency pairs. It works. The threes of crowd will work in all currency pairs. Now, we are in a non-trend. Well, let me characterize the market that we're currently in as a very non-trending market. The market seems to be stifled in a narrow range here. Don't know really why, but what I do know is that eventually this market is going to move away, that we're going to see the market trend away from these areas. So what I like to, when I'm looking at the market currently, and we had the Aussie versus U.S. dollar trends, the upside here today, and actually if you go to the charts in the Aussie versus U.S. dollar, I can't bring it up here because of the way the system's set up. It's in our webinar here. I'd have to resize my screen, and it becomes a difficult situation. Plus, I can't see the questions in the, because I'm on a laptop, I can't see the questions, can't see the screen at the same time, so it makes it more difficult. But I want you all to go to the Aussie versus U.S. dollar. Put 100 simple moving average and a 200 bar simple moving average on your chart. Look at how the moving averages converge, and it sort of laid the groundwork for the trend type move that we had here today to the upside in the Aussie versus U.S. dollar. Now, I know that an employment number came out and forced the market to the upside, and that it got to the upside. It moved quickly to the upside in the move. But here's the thing: is that if you see these two moving averages converge, you are now thinking ahead, thinking about a trend type move, thinking that the market has it's more than a better chance that the market is going to trend away, either to the upside or to the downside. So you as a trader, I wouldn't necessarily go into the employment situation with a position long or short in the Aussie versus U.S. dollar as an example. What I would look for is, if I were trading that session, that because these two moving averages are converged, that this market has a potential to trend, and I'm anticipating a trend. So if it starts to trend, I want to get on that trend. I want to ride that trend. And it may be late. It may be 40 pips away from where the 100 and 200 bar moving average converge. But it 40 or 50 pips is not a trend. And if the market if the market is in a non-trending environment, it has a potential to trend. You have to say to yourself, I have to be aggressive on the buy side when the number came out much stronger than expected, and be aggressive with my buying, and maybe even have an order initiating buy stop and initiating sell stop in the market for anticipating something like this exactly happening. And if you did that, then you would be in on the trend, and you'd be able to follow it more to the upside, catch the second or third leg of the trend to the upside. So that's how. So do that, folks, and or go back, look at the Aussie versus U.S. dollar, put in that 100 and 200 bar moving average, just see exactly what I meant through my discussion here today. All right, crosses seem the best movement at this point in time. Yes, the crosses, the yen crosses are better, are working a lot, are more clear. The euro dollar is having its issues right now, and I haven't looked at it in the last couple of hours, so I don't know where we're at. I know we tried to, or we had a move to the upside. I don't know where we stand right now, but you're right. The yen crosses are working a little bit more clearly, and that's part of your job, folks, as well, is to find those markets, or to scan the markets, try to find those currency pairs where situations exist, where there's potential for profit, and you can go from there. So do that. With 10 and 20 also show the same things. Okay. This is my last question, by the way. With the 10 and 20 also show the same thing. Boyke, I would think that it's too quick. Okay. I don't look at it at 10 and 20. I'm consistent in my approach of how I look at the market. Once again, I use trend lines, I use Fibonacci retracements, I use moving averages. The moving averages, I use 100 and 200 bar moving averages in all the charts, 5-minute, the hourly, the daily. So I am consistent in what I do. That doesn't mean that the 10 and 20 might not work, but what I think, and whether you look at, maybe you look at the 4-hour chart, maybe you look at the hour, I don't know what chart you look at. What I suggest that you do is sample the 100 and the 200. Maybe, it sounds like you're comfortable with the 10 and 20 as your moving average levels. See what happens when those two moving averages converge with the price. What you want to see occur is that the market, the purpose of using the longer term moving averages is to find non-trending markets. and non-trending markets transition into trending markets. So I'm afraid that if you put it on an hourly chart, it's going to be too quick. It's not really showing you a 10-bar moving average is not really showing you a non-trending market per se, or a 10-bar on a 5-minute chart certainly is not showing you a non-trending market. It's just showing you the last 50 minutes of trading. Maybe on an hourly chart it might show something different, and that might be the equivalent of 100 bars on a 5-minute chart. So you may get some clues that way. That's what you're going to have to do. But what you have to, what you as a trader have to realize is that what the purpose of this three-day crowd is to find non-trending periods and non-trending transitions into trending markets. That's what you got to do. So I want to thank the people at FX Street for providing me the opportunity to present to you here today in their beginning course series. I hope that you find this webinar to be informative to you, ways that you can find trending markets, ways that you can anticipate a trend happening. And if you do, and you catch some of these trends, that's where you make the most amount of money with the least amount of risk, folks. Thank you very much again. Have a great day. We'll talk to you all again soon.
Okay, thank you really, Greg. It has been a great session. Anyway, guys, see you back in a couple of weeks with a review of the Beginner's Corners and another webinar that I hope will help you improve your trading. Thanks all, and bye-bye.